Hooray, we're finally done with assets and ready to move to the other side of the balance sheet. The good news is this part's way easier than the asset side. The definition of a liability is shown here. A key component you don't think about is that it has to be the result of a past transaction that you'll have this probable future economic sacrifice. So just telling a friend, oh, I'll come and remodel your kitchen in the next year, doesn't mean you have a liability. There has to be something that happens to really make that a present unavoidable obligation. So your friend has to give you $2,000 to get put on the schedule in order for that to actually be a liability where you owe them that service. Current liabilities, like current assets, are due within a year of the operating cycle. Another way to look at it, since current assets become cash within a year, if you're going to pay your liability with current assets, by definition, those also have to be due within a year. Accounts payable and notes payable are the easiest places to start because they're just the flip side of account receivables and notes receivables. If you think about it, an account receivable to the supplier is an account payable to the customer. So for your accounts payable, we usually use those for your normal purchases on account. If you're a retailer, that's inventory. Like accounts receivable, accounts payable, if you pay those on time, you can often get a discount. If you remember that old 210 net 30. If you have an account payable and you don't pay it on time, the supplier might want you to switch that over to a note payable because a note payable charges interest. Alternatively, you actually can go to the bank and get a notes payable if you want. And sometimes notes payable can be long-term or short-term. So even though they're in the current liabilities chapter, some companies will have long-term notes payable as well. That takes us to some account names we haven't used already. Unearned revenue is a liability. Even though it has the word revenue in the heading, to be revenue by definition, it has to be earned, and this is unearned revenue, so that's a liability. It means we need to do something for somebody before we can earn it, and then it will become revenue. The things that normally happen is the customer pays us in advance for something. So one thing is advances for customers. So again, we're remodeling somebody's kitchen, and we say give us $2,000, and then we'll put you on the schedule and come remodel your kitchen in the next 6 weeks or so. That advance from the customer is a liability. They've given us the cash, that's the transaction, and now we owe them that service. Another time you have unearned revenue is when you sell a gift card. So when McDonald's sells you that gift card, they recognize unearned revenue because they owe you a Big Mac, and whenever you come in, they'll have to give that to you for free because you've already paid for it. So it's a liability when you get the cash. You'll recognize the revenue when you provide the service. So layaway is another example. So in this example, we buy a customer buys a TV from us. They give you $100 down, and the retail price is $1,400. They'll pick up the TV the week before Christmas. When we receive the $100, it just goes to unearned. It's a liability. We owe the person the TV. When they come up in and pick it up, that's when it becomes revenue. We recognize the whole $1,400 when we deliver the TV, not when we collect the cash. Payroll results in a whole bunch of other issues that a company has to contend with. First of all, the employers withhold a lot of money out of each employee's paycheck. My granddaughter got her first job. She figured out how many hours she worked, what her rate was, and was all excited when she was going to get her paycheck. And when she did, she was quite disappointed that it was about 25% less than she expected, and I think she had spent all the money. But the employer withholds Social Security, which is about 6% of the paycheck, Medicare, which is about 1.5%, income tax withholdings, they withhold so that you don't have to pay it all on April 15th. And all of these things they're holding on for you and sending to the government as you work are not expenses to the employer because you're really paying for them. The employer's just sending the money in because the government doesn't trust you to save everything and send it in when they want you to. The employers, though, do have some other payroll taxes. They also pay Social Security tax. So whatever you pitch in, the employer also pitches in. So the government gets almost 12% in Social Security, half from you, half from the employer. Medicare taxes at 1.5%. Again, the government really gets closer to 3% because the employer matches that. And then unemployment tax is one you've probably never heard of because only the employer pays that one. And that covers the unemployment benefits that people get when they get laid off. All of those items, the employer's share is an expense to the employer. So here's a little example, and you can study it if you have a chance, but the key thing is wage expense is the amount you actually earn, your gross pay, even though that's not the amount you get paid. And then the employer also has employee tax expense for their share of Social Security, Medicare, and unemployment. That takes us to warranties, which are a little bit different and again often aren't current liabilities. These may be long-term liabilities. If you remember the matching principle from long ago, we want the costs related to a sale to be expensed in the period of the sale. So that's why cost of goods sold is expensed when we make the sale to match those up nicely. When I sell an item that automatically comes with a warranty, so I have that car that comes with my 3-year 36,000-mile warranty, the customer can't opt out of that. They can't get a discount if they don't take the warranty. Everybody gets the warranty when they buy the item. Then the company owes the customer that repair if it should break. And so FASB says that's a liability because we owe the people that service because we made the sale today. We get to estimate that based on our past experience. And so let's go back to that $1,400 TV. Let's say we sell 100 of them. They come with a 1-year warranty. We can estimate the amount of the repairs. Some problems it will be a percent of the sales price. Sometimes they'll give you a cost per item. Just go with whatever it tells you. But some way we estimate what that repair is going to be. And I want to recognize the expense in the period of the sale. So my cash and revenue is for my $140,000 in TV sales, but then I'm also going to recognize warranty expense to match that with the sale, and I have a liability because now I owe you the service of repairing it if it should break. When you make the repair, then you just reduce the liability. If we're sending cash to a repairman, it's $200 in cash. If we send you parts with a $200 cost, then it would be inventory for the parts. Again, different problems, we'll word those differently. Just credit whatever it is we're sending the repair person. Lastly, we have contingent liabilities. Contingent just means you're not really sure what the timing or the amount is going to be. It's all contingent on how things turn out. Warranties technically are contingent liabilities because we're not really sure how much the repairs are going to be. We know there's going to be some repairs, but not sure about when or how much. But normally when people talk about contingent liabilities, they're talking about lawsuits, we're being sued for patent infringement, fines or penalties. We're BP and we have an oil rig that blows up and it pollutes the Gulf of Mexico. Tax disputes. We've deducted something on our tax return. The IRS is not quite so sure they agree with our estimates, and so we're discussing how much in taxes we might owe on that particular issue. The rules are really pretty easy. If it's probable that you're going to lose and the amount is estimable or estimatable, you book the loss. If it's only possible that you'll lose, then you disclose the issue in the footnotes. If it's remote that you'll lose, then you would just ignore things. We never book anything that's remotely possible. So we just ignore that. Notice all of those things talk about if you'll lose, if you're going to have a gain, if we're suing somebody else and we think we're going to win, we don't book that until the judge actually rules and all the appeals are done, because we're conservative. We book losses when they're probable. We don't book gains until they're going to happen. So in summary, if you have an obligation to provide cash goods or services to another party, it's a liability. You want to think a little bit about what FASB is trying to do and some of the issues they have with management. It's based on a liability. You're going to credit a liability. Most companies don't want to see a lot of liabilities. The other problem is, other than buying inventory, the debit is usually an expense when you book a liability. Companies don't want to see a lot of expenses. And so most of FASB's rules are trying to force people to book expenses and liabilities when they really happen. So companies have a tendency to want to wait before the contingent liability rule. Nobody booked a liability for a potential loss until the judge had decided. Same thing with warranties. Companies didn't voluntarily book warranties until the FASB said you had to. So kind of keep in mind as you go through the liabilities chapters that most of the rules are saying this really truly isn't a future obligation as a result of a past transaction, and you need to book that expense and that liability as soon as you can.